Hey everyone, me Kevin here. We've got to talk about a new coming form of inflation that we haven't talked too much about, but now it's front page of the New York Times, and quite frankly, even though we've briefly mentioned it and talked about it a bit, it is time to fully address this potential risk to our markets. Now, there is also one more big risk that happens tonight, and that is the expiration of the amazing coupon code for getting 40% off on the program's link down below for building your wealth. So check those out before the expiration. Prices will go up tomorrow. Okay, folks, let's get into the topic. Rising rents. Folks, let's address what the New York Times says first, then draw conclusions and come up with a strategy for dealing with this. So again, we're going to start with the article. First, the New York Times says, rising rents threaten to prop up inflation. Let's talk about this. The rental market, they say, which slumped during the pandemic, has snapped back more quickly than economists had predicted. Oh my gosh, economists were wrong, what? And now renters across the country are facing sticker shock. Rents last month rose 7% nationally from a year earlier. Now it's worth noting that housing prices rose about 20% year over year. So rents are substantially behind home price appreciation. Now, home price appreciation could be propped up by essentially lower interest rates. And now, initially, when we think, okay, well, if home prices are up 20%, rent should go up 20%, it's actually not 100% true. We'll talk more about that in a moment. But one of the things for you to consider when you think about the difference between renting and owning is that owning is a form of an investment. And when other alternative investments become less desirable to invest in, maybe stocks are too volatile or they're trading sideways too much or bonds are not providing enough of a yield, investing in real estate becomes more desirable. And the more people invest in real estate willing to accept lower rates of return, the more you could actually see home prices go up and rent prices not actually catching up to home prices. So this is a very, very important concept to consider, and it's basically defined as a compression of yields in real estate that could lead home prices to go up substantially more than rising rents. But bottom line is, rents still went up 7% year over year. Now, we are measuring. A year ago, we're measuring into about June. A lot of folks got rent abatements last year as well. That is, they got offered lower rent, they got rent forgiveness, or they got negotiated deals. We personally have negotiated lower rent deals with tenants last year, and now it's like, oh my gosh, these are like below market. So there's a little bit of measuring into the whole going on here as well. But 7% from a year ago, that's a good chunk. That's a good move for rents. They also mention that we have a 1.8% gain just from May. We're going to talk more about this. The New York Times goes on to say that this could be bad news for both those seeking housing and the national inflation outlook. And that's because rental costs play an outside role in the consumer price index. So in other words, what they're saying here is we might actually see things that are very high right now, like used cars or airline tickets, right? We might actually see these potentially start inflecting down, drawing our inflation readings back down. But if at the same time as these go down, rents go up, we might end up seeing higher inflation for longer than originally anticipated. Let's keep going, and then again, we're going to come up with conclusions. And of course, make sure to get your 40% off coupon code link down below. It expires today, okay? Then I'm gonna stop talking about it. Prices are gonna go up a big chunk. But anyway, both tend to move slowly, but are defying expectations. Okay, that's because, okay, let's break this down. So technically the way CPI defines rents going up is through this bizarro thing called owner's equivalent rent. And it's basically a survey of homeowners going, what could you rent out your property for right now? And that's because there's really not a very good database showing rental comp data. We have frustrations of that as real estate agents as well, because a lot of like leased properties just don't get submitted as comps. So it's very difficult to get accurate housing data. So the most accurate means that CPI gatherers, Bureau of Labor Statistics, has found has been this thing called owner's equivalent rent. It's odd, it's behind, it's not that great, but it is what it is. It's what we have. And what we're looking for, again, are inflection points. This is something that's very important to know about data as well. A lot of folks get really like jazzed up over this idea of, oh, well, the data's wrong, it's rigged or whatever. That's fine. Then just look at the rigged data, so to speak, and look for inflection points or changes in the rigged data. You see what I mean? And then just track the changes, right? Unless, of course, it's rigged to where you don't even see the inflection points. And if you believe that, well, you're honestly probably not watching this video because you got to have a little bit of faith, just a little bit of faith, so you could track at least some data, right? And so that's what we're trying to do, is we're looking for those changes in the market, and this is an inflection point. We're seeing owner's equivalent rent move up fairly sharply, says an economist. I expect it's going to get worse later this year and into early next. I do think we'll see upside from rents, and that'll offset some declines in good categories. Exactly. Like used cars, airlines, durables, whatever, services, whatever. In other words, inflation might stay higher longer. So, but the only way that rents rise enough to keep inflation uncomfortably high, she says, is if wages are persistently higher. Now, wages in the service industry, like retail, hospitality, those are going up substantially. But if you take out the reopening wages, wages actually aren't going up that much. They went up like 0.2% last month, which is very, very low. Anyway. All right, and then we have here, data do suggest that a substantial supply of new apartments should be on their way this year, but it's unclear when those will match up with demand. In other words, builders are trying to build more, which makes sense. That's one of the reasons we saw lumber prices skyrocket so much. Here's a real estate agent who was interviewed saying there's going to be another wave. We're basically at full rental capacity, and we're going to have another wave of people coming back to the office. He says we're just past peak Zoom, which I think is kind of interesting. Zoom video conferencing. We're just past that peak. So in other words, we're still working our way down that bell curve, and we got a long way to go. So far in 2021, rental prices nationally have grown 9.2% compared to the 2 to 3% that is typical from January to June. It's a big, big, big move here, folks. Occupancy rates are high. Rents are a trailing spouse to home price appreciation. In other words, home prices tend to go up first and then rents go up. But remember the warning I gave you about they might not necessarily have to go as much as home price appreciation. The administration officials over at the Biden administration still suggest that inflation will be temporary. Obviously, at least 50% of us do not believe that to be true. And even if Congress passes any kind of rental relief packages or new sort of human infrastructure or stimulus packages, it'll take years for some of these things to actually get out, some of these new things. But now we've got the New York Times article here, and we've got some of the concerns laid out. Let's try to put this together here, okay? All right, so here's how we're going to start. First, look, a quick note on these rental relief packages and things like this, and this sets up just another issue. California has $5.2 billion of rental relief money. 92% of that is from the federal government. They've only sent 6.3% as of the last reading about a few days ago. They've only distributed 6.3% to tenants. That means you've got a substantial number of tenants who are still behind in rent. And so we have this really, really weird environment where what you have, and I'm going to write this here sort of on the bad side of things, right? You have essentially a lot of people who are behind on rent, and then you have this potential for an eviction crisis. And this is happening, by the way, at the same time as you have this potential that real estate prices might start coming down. Now, we've talked about this before, and the easiest way that I like looking up that, okay, why do I think real estate prices might start coming down? Easiest thing to do is just quickly hop on over to the Redfin data center. And what I like to track is I like to track new listings. We see new listings slightly ticking down here. But then you look at prices, listing home prices, and we see that home prices are still up. So home prices are still up. That is new listing prices, what sellers are asking for. The asking prices are up. But at the same time, pending sales are really starting to fall sharply earlier than they usually fall. And that's a potential problem because it's a potential sign of buyer fatigue and a potential stagnating of inventory. So this is another thing, right? Stagnating of inventory. And then, of course, you have buyer fatigue. So you got behind on rent, eviction crisis, stagnation of inventory, buyer fatigue. All of these things are kind of coming together at a relatively similar point. And this is concerning because when you look at this as being a bad, you wonder, okay, well, when could this potentially bubble over? Well, realistically, this inflection point in pending sales and an increase of inventory is going to start affecting prices almost immediately. The real estate market can move very, very quickly. And so personally, I wouldn't be surprised if we start seeing prices actually come down in the second half of this year as we start seeing inventory build up and we start getting this alignment again between buyers and not like 15 multiple offers anymore or whatever. We start getting an alignment again where supply all of a sudden meets demand, right? We're getting back to an equilibrium. As we go back to equilibrium, we could easily see real estate prices come down a chunk. I would say maybe somewhere between 5 to 10% off these crazy highs would be realistic. And in that case, we might potentially end up in the situation where, let's say home prices end up, I don't know, 12 to 14% higher than they were before the pandemic. It wouldn't surprise me to see rents somewhere between 12%, 10 to 12% as high as they were prior to the pandemic. So I do think we're going to get that rental, appreciation in prices. I do think we're going to see home prices come down from that crazy 20% gain, just level out a little bit. I'm not sure if we're going to get a culmination of a massive crash, but you never know. Because in order for us to get like a massive crash, we'd really have to see home prices give up not just their 20% gains, but then probably fall another 20 to 30%. I don't really see a catalyst for home prices falling 50% unless interest rates like skyrocket 2 to 3 to 4%. And I don't believe that's what's going to happen. Now, there is this belief that, well, wait a minute, Kevin. If this is what inflation looks like right now, and inflation is so high, and then all of a sudden used car prices and airlines come down, but pushing it right back up are rent prices, then you could be in the situation where you have higher inflation longer and maybe the Fed is forced to raise rates. I do believe that could be true, and it is possible that we will see higher inflation longer, but I do believe that eventually rents will also start inflecting down. We might just end up getting a delay as to when we see inflation inflecting to the downside. That could be short-term painful for markets. And so I want to be prepared for the potential of having inflation in the market, as well as the potential for having less inflation than we expect in the market. So I'm really taking this sort of sideways trading, maybe a little bit of deflation, falling prices in the housing market, a little bit of a sideways a trading or investing mindset. But before I get into that mindset, I think it's worth quickly noting this here. The CPI estimate of home prices doesn't come close to reflecting the market. I thought this was really interesting. This is the CPI's owner's equivalent rent right here is this blue line right here, and home price appreciation is the black line. And it's just worth noting that over the last 21 years, you've had a much slower movement in rent prices than you have in housing prices. So usually you can get these extreme 20% ups and downs or whatever in housing prices. But I believe that we'll probably have a more muted rental appreciation where maybe we get 5% over 2 years, right? Compounded, that'd be like 11%-ish, somewhere around there. And I do believe house prices could be doing something like that, where essentially we get this parabolic move up and then almost like a momentum stock come down and sort of level off. Maybe it would be a little bit softer, something to that effect. Okay, so now how do we make conclusions and how do we want to invest in this? Well, so here's sort of a very clear bottom line on my belief. My belief is that we will see probably higher inflation longer. So inflation longer, and that's potentially due to rents going up. So more inflation longer. In that event, we're probably going to have sideways trading in the stock market longer. And that means I really don't want to be a buyer of option contracts. I want to be a seller of option contracts. So I want to be a seller of options, but I also want to be prepared for large dips. So I want to have cash saved up. And then I also want to be prepared to shop in the housing market. So that's going to be a big deal, in my opinion, is going shopping in the housing market. Very, very excited about potentially shopping in the housing market and finally getting some wedge deals again, below market value transactions. Why would I want to get into real estate? Because real estate ultimately is an inflation hedge. When there's inflation, real estate is a great tool for hedging yourself against inflation. And I want to take advantage of being properly exposed to growth in tech stocks and stocks, but also have my inflation hedge in real estate. So those are some of my beliefs and thoughts about this market and how we're going to potentially deal with this rental inflation danger. So these are my thoughts. Hopefully you find these helpful. If you did, consider subscribing. If you like the way I explain things, consider checking out my amazing programs linked down below and use that 40% off coupon code. Folks, thank you very much for watching, and we'll see you in the next one. Bye.